প্রশ্ন করেই ঠিক আছে। At this screen. Okay, fine. Yeah, later. Okay, okay. আওয়াজ হবে আওয়াজ Good afternoon. I hope all of you who were coming are all settled by now. So let's begin. Okay, so we are going to begin our second keynote lecture of the day. It's really my pleasure and honor also to introduce Professor Dilip Mookherjee. Professor Dilip Mookherjee is a professor of economics and director of Institute of Economic Development at Boston University. He received his PhD in economics from the London School of Economics and has previously taught at Stanford University and the Indian Statistical Institute. We had a lot to say about him, but on his insistence, we'll have to soft here just with the two-line bio. And just to add on a personal note, Professor Mookherjee had been also given one of the keynote lecture in the year 2022 of our annual economics conference, but during COVID time that had to be online. So we are really thankful that he made time to join us here in person this time. So thank you one more time. Over to you.
Thank you, Abhinandan, and thank you, everybody at Ahmedabad University. It's a real pleasure to be here. It's the energy, I think the interest, particularly from the students. You know, they've sent me emails. They wanted to read my papers. They've read my papers. They've sent me 12 questions. The first person I met as I stepped onto campus saying, "Sir, in that paper, why did you make that assumption?" So, I mean, that's fantastic, okay? So that's why I said, you know, cut out the long introduction. Okay, let's just get down to business and talk about economics. All right, so this is, I'm going to talk about something I've been working on for over 20 years. Yet this is kind of, we've written a sequence of papers, this team of Pushkar Maitro, Shondit Mitro, and Sujata Visaria. We've written a sequence of papers on West Bengal potato, and this is the latest paper, which is not yet written. It's still work in progress, and this is the first time I'm going to be presenting it, so it's not going to be very polished, I'm afraid. But I'm really excited about getting your feedback. All right, so let's get started. So the first point I want to make is that agricultural marketing is an important topic that deserves more attention. And of course, policymakers are very interested in it, but the academic community has been a bit slow. So in traditional development economics, you know, we do land and credit and all that and interlinkage. But the marketing side, I think, has received less attention. And there was a time when I used to spend a lot of time working on land reforms and decentralization in West Bengal. And one day, the person who was helping me was a master's student in the local university. And he said, "Sir, why do you spend so much time on land reform? Land reform is no longer an issue in West Bengal. It's done. You know, there's no more scope for land reform." So I said, "So where is the action?" And he said, "Well, credit and marketing in particular." Okay. So then I worked for a couple of years on credit. And they'll be part of the talk today. And credit is important for marketing as well. But I wanted to focus on marketing. And most of the discussion of agricultural marketing in India has focused on on APMCs, government procurement, and so on. I want to focus on something else, which is there's a difference in the organization of marketing supply chains, particularly at the local level, between Eastern India and the rest of India. And I'm going to focus on West Bengal as symptomatic of what is seen more generally in Eastern India. So there's a very nice ethnographic descriptive report of agricultural marketing in Bihar, Odisha, and how it differs from Punjab, for instance. And a lot of other literature that I'll talk about later makes the same point. So West Bengal is similar to Bihar and Odisha in this respect. And the most important fact is that farmers are excluded from mandis or wholesale markets. Farmers do not sell directly in mandis to wholesale buyers. That's the fact. Who do they sell to? They sell to other traders in the village, who in turn sell to other traders sitting in the mandi, who in turn sell to the buyers. So there's a whole hierarchy of marketing layers intervening or between the farmer and the mandi buyer. Okay? And the second fact about Eastern India that's important, that's well documented in this report by Chatterjee, Krishnamurthy, Kapoor, and John, is that APMCs and government procurement play a very negligible role in Eastern India. So I'm going to be interested in this exclusion of farmers and what it implies for performance. Now, you may ask, well, why is Eastern India so different? And I don't think I really know the answer to that. I don't think anybody knows why we have this very distinct way of organizing marketing in Eastern India. One possible reason I speculate is that land is much more fragmented in Eastern India. I've been looking at NSS data the last 2 days, and unfortunately, I couldn't just put the data together in a satisfactory way, but I can't tell you the exact numbers, but no matter which way you cut it, if you look at the NSS land surveys, it's unmistakably the case that Eastern India, the land is much more fragmented and so as a result, you have many more farmers. For a given land area, there are many more farmers that are living there. The second possible reason that may be different in Eastern India is that farmers depend a lot more on local traders for credit. The penetration of formal finance and even microfinance in Eastern India is much less than compared to the rest of India. Anyway, so owing to the much larger number of small farmers that operate in any given area, a wholesale buyer does not have personal contacts with sellers. They do not know farmers individually. They do not have the time or capacity to transact with so many different sellers. So they delegate procurement to mandi traders. But even for a mandi trader, they also don't know the individual farmer. So they in turn delegate to village traders. So what you have is a hierarchy of what are often called consolidators, aggregators. These local traders negotiate with individual farmers. They inspect, for instance, they screen first who they buy from. They inspect the potatoes. They may store the potatoes. They transport the potatoes and then deliver in bulk to the next layer of traders above in the supply chain. So just to illustrate the West Bengal potato supply chain, what you have is you have farmers, at the bottom layer here, and they supply either to village traders or they might, so these village traders are buying at their doorstep. So this distance is 0 kilometers. Or farmers have the option of taking their crop and selling it some local markets or huts, which are located, the average distance is about 5 kilometers. And then you have either these village traders or you have traders sitting in these local markets who in turn are selling to wholesale traders. In Bihar, they're called arthiyas. Or they may be selling to commission agents who are hired by these wholesale traders. So then you have these wholesale traders who are buying from these village or local traders, and then they are selling to buyers in the mandi. And buyers in the mandi are coming from the city. So in the 2 districts that I'm going to be working on, Hooghly and West Mednipur, the relevant city for Hooghly is Kolkata, and for West Mednipur is Bhubaneswar. Or you have agents coming from various other states. So that's basically a description of the local supply chain for potatoes. Now, how do prices vary across these different layers? So this is something that's very hard to find unless you actually do surveys. So we've done surveys and we've been surveying farmers here. I'll tell you more detail about the surveys. But just to give you an idea, the first paper that we did was focused on the year 2008, which was somewhat unrepresentative. I'll that later. But in the year 2008, it was an exceptionally low price for that year in potatoes. But in the city, the price for this is Jyoti variety was 6.28 per kg in the city markets. At the mandi level, they were selling for 485. In the local markets, they were selling at 2 rupees 30. And what was the farmer getting? 2.14 if you're selling to a village trader, or 2.19 if you're selling to local market. So you see that the retail price is about 3 times what the farmer is getting. Market for potatoes or... Yes, this is the ready. Yeah, there is a separate bond market. Yeah, and yeah, that's right. You'll see similar gaps in bond prices as well. Yeah, but I'm going to focus, most of what I'm going to show you are ready potatoes. So, okay, retail prices are typically, this was a low price year, it was 3 times. In a high price year, it's about 4 times. I'll show you the data later. So you see a big gap between retail prices and farm gate prices. Now, the question is what accounts for that gap? So part of it owes to costs that are incurred by traders, provided a lot of important value-added services, screening, inspection, storage, credit, transport, as well as the cost of risk bearing. So there would be some return on those costs, and the rest would be the rents or the pure profits of the middlemen, which could owe to oligopsonistic market power that traders have vis-a-vis their transactions with farmers. The problem is that it's hard to figure out, the separation of costs from profits is hard because it's difficult to obtain data on transactions across successive layers of local traders and their costs. So it's difficult to disentangle the trade costs from the actual middleman margins. Now, why do we care about how large these margins are? Well, one is you could have a view of sort of this marketing organization is that this represents a form of market failure. That middleman rents represent frictions, or in the macro trade literature, these are called wedges. Okay, wedges are like taxes, distortionary taxes, which lower agricultural output, which lower market efficiency and lower farmer incomes. So this is a context where efficiency and equity implications go hand in hand. If these wedges are small, you have more efficiency and you have more equity because the farmer is getting a larger fraction of the potato price, the retail potato price. The alternative view, which is, well, these are actually efficient markets, the middlemen provide a valuable service, and the returns to middlemen represent a competitive return to the various value-added services they provide. Okay, and there's a well-known paper by Irfan Aleem in the context of cotton trade in Pakistan, cotton traders and their relationship with farmers and so on, where you see a big gap, but then he does a careful counting of all these costs and argues that they represent a competitive rate of return on those. So the key research questions are, well, how large are these frictions? Okay, how large are these real wedges? Are they distortionary wedges or not? So which hypothesis is correct, the efficient or the market failure approach? If there are frictions, then what are the underlying causes of these frictions? And then finally, well, what policies might be effective in lowering these frictions? The 3 sets of questions I'll be concerned with. So the context we are studying is potato, which is the leading cash crop in West Bengal. Our surveys show that the value added per acre in potato is more than 3 times higher than the next most valuable crop, which is paddy. And in fact, if you visit the potato growing districts in Bengal, it's commonly referred to as the pathway out of poverty for farmers. So we've been collecting data at a high frequency on cultivation, on transactions, trading costs, mandi and retail prices from farmers and traders as I said, we started in 2007. So our surveys have been going on from 2007, and we collected data until 2013. And what I'm going to talk about today is, so we did an initial study, which was between 2008. We've written some papers based on that, which are already published. I'll describe those. But there was a subsequent data collection, which was done much more carefully as a result of the pilot that we had done earlier, which spanned 2011 to 13, which is what this paper, what I'm going to talk about today, is going to be about. So we selected two main potato growing districts in Bengal, which is Hooghly and West Mednipur. And then within those districts, selected randomly 72 villages. And then within those villages, we randomly we did a door-to-door listing of all households and then asked them their occupations. And then amongst those who cultivated potato, we selected, again, randomly potato cultivators. Okay, so that's our farmer sample. I'll tell you about the trader sample later. Causal inference, we are going to exploit and going to argue that these city and mandi price shocks are plausibly exogenous, basically reflecting demand shocks in the market. And then we will use a field experiment where we provided access to farmers, to randomly selected farmers, information about mandi prices. So it was an information intervention, as well as we provided microcredit to them, to a different randomly selected set. So basically, there were two treatments. One was a price information treatment. The other one was a microcredit treatment to different sets of farmers. And what we had done in the prior paper, which we published in Review of Economics and Statistics in 2017, was an information experiment. So we had carried out just the information experiment for 1 year in 2008. So we are repeating the same information experiment now for 3 more years for reasons that will become clear. And we also extended it to include the microcredit intervention. And we've been sitting on this data for the last 7 years, and this is the first time I'm presenting the results. So I'm really excited about getting your feedback on it. So now you can measure frictions or wedges in 2 different ways. The first thing we do is we use our trader reported data. When we survey the traders, we also ask them about all their transactions at a high frequency, as well as their transaction costs. So we use the trader reported data on transactions, prices, and related buying, selling costs. And then, so basically we are trying to account for cost and separate from the gross margin that they're making, the part that is the selling cost, to infer what the margin is. So that's trying to estimate the pure rent of the traders. The second thing we are doing, which is a econometrically superior procedure, I'll explain why, is a pass-through. So you exploit temporal changes over time using the high frequency of the data of weekly fluctuations in city prices, which is plausibly exogenous for this context, because we're looking at Kolkata and Bhubaneswar prices. To prices as how do those shocks percolate down the supply chain at various levels. Test hypotheses regarding underlying mechanisms. So one set of hypotheses will be that standard IO models of collusion and concentration, just based on trader market power. And the second will be the set of frictions that are important as conventionally stressed in the development literature. There's all kinds of contractual frictions between traders and farmers. So there could be relational interlinked trader-farmer contracts. There could be asymmetries in access to information and credit. And then we'll estimate effects of policies that enhance farmer access to information and credit. So that's the agenda. Let's see how far I don't know how well I'm going to manage time, but okay, I'll do the best I can. So preview of the main results. First, we find large frictions between mandis and farmers. Specifically, we're going to find high middleman margins, and we're going to find low pass-through of retail mandi prices to farm gate prices. Second, we're going to find that these frictions are larger at a higher layer, that is the transactions between wholesale and local traders, compared to the lower layer, between local traders and farmers. Third, then we'll be testing theories of collusion, and we'll be focusing in particular on a theory of Rothenberg and Soloner, which was published in the AER in 1986, which is a theory of dynamic self-enforcing collusion, which predicts countercyclical margins. And consistent with that theory, we are going to find frictions are lower in years with high city prices. And information interventions increase farm gate prices in high price years, but have zero effect in low price years. And finally, when we do the credit interventions, their effects are null. We find no effects of credit interventions. So in contrast to our previous RE-STAT paper, which focused on an information intervention in the year 2008, as I told you earlier, that happened to be an exceptionally low price year. So that's consistent with our finding here that in low price years, the information interventions have zero effect. But the new result here is that in high price years, we were lucky enough that the price did rise significantly in 2012 and 2013. You find a significantly positive information intervention. Okay, so our related literature on this topic, I guess I've mentioned already the ethnographic descriptive evidence markets in Eastern India. There's a nice set of papers by Meenakshi and Banerjee on collusion in North Indian auctions and effects of government procurement. Then Soumitra Chatterjee has a nice paper on the effect of APMC regulations on interstate transactions on local market prices. But as I mentioned earlier, Eastern India doesn't have any APMC auctions. So these two papers, which have reasonable identification strategies, don't really seem to be relevant in the Eastern Indian context. And then you have a couple of papers on information RCTs in Maharashtra, MP, and then our earlier work in West Bengal. So what's distinct about what we are doing currently in this paper, we are providing causal evidence of marketing frictions between local traders and farmers in Eastern India. And we're evaluating the effectiveness of different policies in reducing these. Okay, so that's now I can jump into the institutional details. So until what time should I go on till? 1:15. Okay, good. All right. So now there are 5 or 6 different varieties, but there are 2 main varieties. Jyoti accounts for 70% and Chandramukhi is about 20%. So most of the results I'll present will just focus on these 2 varieties. Potatoes are harvested once a year between March and April. About half the crop is sold by farmers at the time of the harvest, and the remaining is stored. And they are stored either in their farmers' own homes, but mostly in cold stores. West Bengal, if you travel in this area, you will find it every 2 or 3 kilometers, you'll see a gigantic cold store. So there's no shortage of cold stores. And farmers can go deposit their potatoes in 50-kilo sacks in the cold store, get a receipt for it, and then those receipts are sold. So that's the bond market that Sanjay was talking about, okay? And so they can engage in intertemporal price arbitrage. They can, because prices are higher later in the year. And so they can hold on to their bonds and then sell the bonds on the bond market later in the year. The bonds would typically be bought by the local traders. So there's an active secondary market in trading of bonds throughout the rest of the year. And post-June trades are mainly in potato cold store bonds. And the entire crop is sold by December when the stores close. There are significant out-of-state exports, Odisha, Assam, North India. So most of the demand shocks that I'm talking about is coming, or factors coming outside West Bengal. Story. There are cold store owners. Some of them are all. Yeah. There's very high price volatility across years. So there's volatility. There's also a lot of variation within year. So prices are typically higher later in the year compared to the harvest time. And also there's cross-sectional variation across mandi areas and across districts. So here is just to give you an idea of what is the dominant source of price volatility. This is an analysis of variance of weekly mandi prices across four years from 2007 until 2012. And you'll see that the gigantic source of volatility is across year. So this is a breakdown of sources of variance, and year accounts for about the year itself, 1 year to the next, accounts for more than 95% of the total variance. And then you have relative some variability across the period of the year, between the early part and the later part of the year. Then the interaction of year and period, then cross-sectional mandi, the mandi area itself, and then mandi year effects. So the big takeaway here is that the largest source of volatility, and it's really large, is across years. The second important fact is that mandi prices are not in the public domain. Most of the transactions that happened at the mandi occur behind closed doors. And so it's only the traders who are selling, the wholesale traders, buyers and sellers, they know what the mandi price is. Other people don't know what the mandi price is. So in fact, one of the big problems we have with implementing the information intervention is how do we know what the mandi price is? So eventually we had to bribe somebody, a trader, who disclosed to us a daily price of different varieties. So traders have much better access to information about mandi prices. They also have much better access to credit. And so they are better placed to engage in intertemporal and also interspatial speculation through the active bond market. So farmers are at a bargaining disadvantage vis-a-vis local traders because local traders have access through the trader networks, information about what mandi prices are. So traders have a better idea of what price they would be able to resell to the wholesale traders.
Market price they observe.
Market prices, mandi price is not observed. What you can observe is the city price, but you cannot observe, and also the city price you'll observe with a lag. So if you want yesterday's price at the mandi, and I showed you earlier that the mandi price differs quite a lot from the city price. If you want to know what the mandi price is, you cannot. As a farmer, you cannot. So farmers are at a disadvantage because the traders they're selling to know what price they're going to be able to sell the potatoes, but the farmer doesn't know what it is. So there's an asymmetric information about the resale price. And also farmers are subject to greater credit constraints compared to the traders. So that's why there's a potential role for policies that provide farmers with improved access to both price information, mandi price information, and credit. Okay, so the field experiment we designed, as I told you, 72 villages in Hooghly and West Medipur, located at least 8 to 10 kilometers from each other to avoid information spillover. We selected randomly 50 potato growers owning less than 1.5 acres of cultivable land in each village. And the information experiment, we chose 36 villages randomly. And in those 36 villages, we publicly posted at a prominent place, either in the local school or a grocer's store, ready and bond mandi price information for each potato. In the credit experiment, we randomized the set of 72 villages into 3 credit treatments. Each of those 3 treatments randomly selected farmers. I'll talk more about the details of the credit experiment later if I have time, to 3 different microcredit interventions. And farmers were surveyed 3 times a year for 3 years. That's what I'm going to report on here between 2011 and 13. So details, minute details of production, of costs, of storage, and of trades.
Again, it's information experiment means like what that would be sort of a proxy or some idea with that sort of like the openness of the prices, all prices.
No, but again, information of, yeah, the farmers are not really engaging in bond transactions. Some of them are, but yeah, but they have anyway. So the information experiment will transmit information through mobile phone calls to somebody in the village about both the mandi price as well as the bond price. Yeah.
How far are they?
The approximate distance is about 8 to 10 kilometers. Yeah, so it's really very local. Yes.
There is the information.
There is the informational asymmetry, yeah. Okay, now the trader sample. So we have a representative sample of potato farmers. Each potato farmer, we ask them, who are you selling your crop to? So then we have a list of buyers. From that list of buyers, we randomly select 2 in each village. So we have then a sample of 144 village traders who are buying from the farmers. Then we ask that layer of traders, who are you in turn selling to? Okay, and then we have another corresponding, and then of the larger traders that were buying from the village traders, we randomly selected 108 of them. And then of them, 86 decided to participate. So we have data, the trader level at 2 layers above the farmer. And we did trader surveys. The trader survey, however, is very, very tricky to interview traders and get them to disclose information about their business at a high frequency level. We managed to do it only for 1 year, 2013, for 40 successive weeks, which covered most of that year. And so anything I report in terms of trader reported information, it's only for the year 2013. Okay, so now let me get into the descriptive statistics. So this is about traders based on the 2013 trader data. And the important thing to note is, so we have these 2 layers. We have village traders. Actually, we have 3 layers. We have village traders, we have local traders, and then we have wholesale traders. Okay, that's not in the picture here because we could not interview wholesale traders. Village traders are, who are they selling to? The percentage, so they sell either to wholesale traders or they sell to other local traders. So it's about equally divided, 45%, 42%. Okay, and then 10% they're selling to commission agents of the wholesale traders. Who are the local traders selling to? Mostly 87% to wholesale. So the sort of local hierarchy is that village traders sell to local traders. So these are slightly above the village. So their domain is 3 or 4 villages. Because as I said, this is layers of aggregators. And then those people are then selling to the wholesale traders. Okay. But basically, if you look at the prices that they are receiving, the village traders and the local traders, they're pretty similar. So it just, as a first step, it helps to simplify the analysis by just collapsing the village traders and local traders into one group. Just call them local traders. Okay. So from now on, I'm just going to assume that village traders and local traders are the same. So you have the farmer, you have the local trader, and then you have the wholesale trader. Okay, so let's focus on that. Okay, so now, first, let me show you the weekly average plot of city, mandi, and farmer prices between 2011 and 2013. Okay. So first, you see a lot of variation in city prices across years. The average price in 2011 is around 8 or 9 rupees. In 2012, it rises to 24 rupees. And in 2011, it's about 15 rupees. So 9, 24, 18. So that's the huge variation across years. Okay. Second, you'll see within year variation. So the harvest time, this is roughly the harvest time. Okay, so the harvest time is roughly here. And the price is going to rise later in the year. Middle of the year and later on is when the price is going to be a lot higher. So there's variation across periods. Now, the red line is the city price. And the blue line is the mandi price. So the next fact is, despite these wide fluctuations in city prices, the mandi price is pretty much tracking the city price. Okay, so those 2 markets are tightly integrated. But then look at the prices that farmers are getting. There's a huge gap. Okay, and the co-movement, there is, you can see that they do co-move to some extent, but that extent of co-movement is a lot lower. Okay. Now we've seen these big gaps between the mandi and the farmer. How can we break that down across those layers? And here, just using the trader survey data for 2013, so the red is the city price. This is broken down between the two districts, Hooghly and West Mednipur. And you see a bigger gap between city and mandi in West Mednipur because here the potato is traveling all the way to Bhubaneswar. It's a much longer distance than between Hooghly and Kolkata. Okay. But the large gap, as we saw earlier, is between the mandi price and the farmer price. And the farmer price is the blue line here. But then you see that the prices that the local traders are getting is very close to what the farmers are getting. So most of the gap between first city price and farm gate price is the gap between the mandi price and the farmer. And that in turn is largely the gap between the mandi trader, the wholesale trader, and the local trader. Okay? And so only secondarily, the gap between the local trader and the farmer is relatively. Then next step, we did a very detailed cost accounting exercise for the traders to back out their costs and calculate the net margins. And this is, of course, only for the year 2013. So the local trader net margin is only 39 paise in the year 2013. Compared to the wholesale trader, the net margin was 6 rupees and 16 paise. So again, just confirming what you saw in the figure before, even if you do the cost accounting, the cost variation is not that important, really. It's really the prices, the transaction prices on the crop itself that is just driving the margins. And these margins for the wholesale traders are enormous. So how do we compare that margin with what the farmer is getting, the guy who's actually putting in all the work and producing the potatoes? For the farmer, the net margin is 1.8, but for the wholesale trader, it's 6.16. So collectively, when you look at what the traders are making relative to what the farmers are making, the trader in the year 2013 is making roughly 4 to 5 times what the farmer is making. Next step, well, you may be concerned that, well, we maybe accounted for observable dimensions of cost, but what about all kinds of unobservable dimensions, credit, risk bearing, et cetera, et cetera. So for that, it's useful to look at the pass-through. So you run a regression of prices at the weekly level and look at how changes in city prices are translating into changes in the mandi price and changes in the farm gate price. So what you see first is that when you regress the mandi price on the city price, you get coefficients that are close to 1. Again, reflecting the tight integration of the city and the mandi. But then when you regress the farm gate price on the city price, okay, and you do it for different years, you get coefficients that are roughly of the order of 0.2. So 1 rupee increase in the city price, 20% of that is going to the farmer. And how much is the local trader getting? This is the local trader, is about 0.3. So 70% of it is being absorbed is effectively by the wholesale trader. Now, price pass-through coefficients are a more accurate measure of market power at various. So almost any model of IO model of collusion or concentration you care to look at, one way of controlling for costs is to look at the pass-through. Okay, and basically, the more concentrated the market, the lower the pass-through. So the main takeaway is that the city and the wholesale market is highly integrated, but you have very low integration of local markets. Just that 8-kilometer distance from the mandi to the farmer, and you're seeing that the pass-through is only 0.3 to traders and to farmers is about 0.2. So you got really very high frictions between the wholesale and the local traders, and some frictions. So the pass-through that you can back out from the local trader to the farmer is 0.55. Okay, that's still a far from 1. Okay, so you also have frictions at the very last layer between the local village trader and the farmer. Okay, so now what could be, so the first question now we are answering there is evidence of substantial frictions, at least based on this. What could be possible explanations for these? One is the standard IO explanation. These markets are concentrated. Traders have market power because there are relatively few traders. Second, there's asymmetric information between traders and farmers about the downstream prices at which the traders will resell. Third, well, these may not be, the standard static models of, that we have in IO. There are long-term relationships between traders and farmers. And maybe what we're observing is an instance of long-term risk sharing, of insurance being provided by traders to farmers. So the traders are telling the farmer, I'll give you I'll guarantee you a certain minimum price. Okay, and that is providing you with insurance. And in return for that, I'm going to take part of the surplus. So that could be a possible explanation. And then finally, there could be contracting frictions, such as trade credit, reputation. There could be search or switching costs. All of these can restrict competition. And then low prices or pass-through may reflect implicit charges for trade credit. So in the interlinkage literature, it's commonly asserted that part of the reason why the price that the farmer may get is low is because it's reflecting a hidden charge for loans that the farmer took from the trader at the time of planting the crop. So there is a possibility of that hidden charge for trade credit. So we did very detailed one-time qualitative surveys of these farmers and traders. And those surveys, just to summarize, so there's a paper we've written just on the descriptive evidence. There is no evidence of a number of those explanations I listed in the previous slide. So there's no evidence of high buyer concentration. The median number of local traders per village is 9, which is very large. The corresponding Herfindahl index ranges only between 0.1. The same thing is true in the relationship between the local traders and the wholesale traders. The median number of wholesale traders to whom local traders sell have actually sold in the last 2 years is 5. So local traders also have a lot of choice in terms of which wholesale trader to sell to. Second, there's no evidence of any long-term contractual arrangement. These are entirely spot transactions. No evidence of any lock-in. So sellers, you ask farmers, you ask traders, are you locked in? Are you compelled to sell to some particular trader at the next layer? No, I am free to choose. I have choice, and there's information about who is charging what prices are being transacted within the village is commonly known. It's just because there's a lot of exchange of information within the village. Farmers know a lot about what other farmers are selling at, and similarly for traders. So there's very little search or switching costs. And finally, trade credit, 80% of the farmers report taking no loans from the traders. So there's no evidence for a lot of sources of high frictions. On the other hand, the surveys also do reveal that traders incur large entry and setup costs. They need to build up reputations for delivery and repayment reliability, and this takes time to build. So trader rents could be a return to set up reputation costs. And so there's a theoretical paper that I wrote with Pranab Bardhan and Masatoshi Sumagari on middleman margins, which was based on exactly that kind of a mechanism. However, even for that mechanism, it's a real puzzle. This is the puzzle that we've been wrestling with for the last couple of years. How can these trader rents be sustained in what appears to be a competitive spot market with multiple buyers and sellers with low search and switching costs? For instance, if buyers are engaged in static Bertrand competition, why don't these rents get dissipated? So now we're going to explore two possible explanations. The first is that they're not engaged in static Bertrand competition. There's some kind of dynamic self-enforced collusion amongst the traders. So buyers are tacitly colluding in their price offers by monitoring what other traders are offering, let's say farmers, and then they have some kind of a common understanding of what prices they will be offering on any. And if anybody breaks that norm, then they will punish each other by then deviating thereafter and abandoning collusion and reverting to static Bertrand computation. So that's one explanation. We are going to test this. The other explanation is asymmetric information, the informational advantage that traders hold with respect to farmers about the resale price. So what we'll do is we designed an experiment to test these two hypotheses. Okay, so I'm not doing very well for time. I have 10 minutes. Okay, so the rest of the talk is I'm going to tell you about the results of these two experiments, and I'm going to focus mainly on the information experiment. And we're going to test a variant of the Rothenberg-Saloner theory of tacit collusion. Now, the main ingredient of the Rothenberg-Saloner theory is it applies to a context with significant idiosyncratic demand shocks. And I've showed you there is evidence of significant demand shocks from year to year. And this theory predicts that collusion can be sustained only in periods of low demand. Why? What happens? Why can't collusion be sustained in high price years? Because the temptation for this cartel to deviate from any cartel arrangement, which keeps prices below the Bertrand equilibrium, the temptation to deviate is very high. Because if you now offer a slightly higher price, you capture most of the market. And then it's a high price here, right? And so you'll make a lot of money, immediate money. Okay, now you'll be punished maybe next year. But next year, prices are going to go back to, ultimately, it's basically it may not be an IID process, but it's a reverting process. It's a stationary process. All right. So as far as the future is concerned, the threat of that punishment is going to be the same in every year. But the temptation to deviate is going to be high in the high price years. So collusion will break down in the high price years. And so in the high price years, you'll get competition. In the low price years, you'll get collusion. Okay. Now, the first, is this true? So the smell test is, well, if this is true, then the pass-through rates should be a lot higher in the high price years. Well, I showed you the pass-through evidence. That is indeed the case. The pass-through was a lot higher in 2012 and 2013 compared to 2011. Okay, so it passes the smell test. But now I want to use the RCT. And to do that, I need to incorporate asymmetric information into the Rothenberg-Saloner theory. So we extend that in the paper. And we derive a testable prediction of the theory of the coexistence of this kind of Rothenberg-Saloner collusion and asymmetric price information with the field experiment. Okay. So now, very quickly, the underlying assumptions of the model. This is similar to our RESTAT model. Farmers have the option to sell to one of multiple traders within the village. They sell at the farm gate, so they don't have to incur any transport costs. Or if they refuse the trader's offer, they can take their potatoes to a hut, which is located 5 kilometers away. They have to incur the transport cost. So that's their outside option in bargaining with the local trader. The trader's resale price is larger than the hut price because these guys have access to reliable connections as well as transport. But both the outside option and the trader resale price are increasing in the mandi price because eventually both sets of traders, the hut traders and the village traders, are reselling at the mandi at a price which is co-varying with the mandi price. The traders know the mandi price, the farmers do not. So the farmers don't know what their outside option is. But in order to find out the outside option, they have to incur the transport cost of taking their crop to the hut. Now, traders make price offers to farmers, and the price offer is used by the farmer as a signal to update their beliefs about what the mandi price is, which will tell them what their outside option is. So that's the kind of bargaining in asymmetric information context. Farmers are heterogeneous. They're located at different distances that we assume is uniformly distributed from different traders and from the hut. And we select parameter values that result in interior market share equilibria for village traders. And then the this model predicts the following, that the average information treatment effect is positive if traders compete, but it's zero if they collude. If I combine this with the Rothenberg-Salerno hypothesis that traders compete in high price years and collude in low price years, the overall prediction that I can test with the experiment is that the information treatment effect is positive and large in high price years and zero or small in low price years. Okay, and this is very quick attempt to explain the intuition for this test, this prediction. If the Mandi price is low, the farm gate price is increasing in the Mandi price, but increasing linearly because they're colluding. Okay. If they're competing and they compete in the high Mandi price years, the price jumps up because here they are competing, right? So as a result of that competition, the elasticity of supply from farmers is increasing. So there's an elasticity of supply that's coming from competition with rival traders in the same village, as well as an elasticity with respect to competition with respect to the outside hot market. So this is the sole source of elasticity in the collusive regime. In the competition regime, there's increased scope for competition. So the price jumps up. Moreover, while the price increases linearly in the collusive regime, it increases at an increasing rate. So this price function is convex. So now when you provide information, then of course, the farmers know what the Mandi price is. So the price is going to track the actual true price. Whereas if the farmer doesn't know, then the traders offer pooled offers, and the pooled offers will basically average out the farmer's information. So the uninformed price that will be offered by the trader will be the flat, and that is what will actually obtain in the uninformed villages. In the informed villages, the price will track this one. So because the price function is linear in the Mandi price in the collusive regime, these two averages will be the same. But in the competition era, because of the convexity of the trader's offer with respect to the Mandi price, Jensen's inequality implies the information treatment effect is going to be positive in the competitive regime. Okay, so that's basically the prediction, and now these are the results. So there's an information treatment, and we're looking at the information treatment effect. This is the average difference between farmers in the information villages and the farmers in the villages that did not receive information. And then this is the effect in 3 different years, 2011, 12, and 13. So effects on output is positive but insignificant. But effect on the farm gate price is 0 in 2011. It is 2 rupees in 2012. That was the really high price year. And 1.27 in 2013. When the price was higher, remember it was 15 rupees as against 9 rupees in 2011. Okay? So this is a very substantial increase in the farm gate price in the high price years. Okay? Now, one theory also of why the process by which information matters is that if the farmers have access to information, then they feel they can also engage in speculation. Okay, and so they don't sell as much in the harvest, they themselves store and sell later in the year. Well, that mechanism doesn't seem to be operating. So the percentage of crops sold by farmers at the time of harvest is, again, not affected by the information treatment. So the only effect is really coming from the change in the farm gate price. And if you compute the corresponding effects on the profits of the farmers, these are very substantial profit effects for farmers. So just the key takeaways from the information experiment, we are seeing large effects, 35% and 24% effects on the farm gate price in the 2 high price years, a 0 effect in the low price year. And this is similar to what we had found in our 2008 experiment. And then the corresponding effects in the high price years here on the farmer's profit was 52% in 2012 and 26% in 2013. So this is the exciting result that we have now, which is our new result. And this effect is operating purely through the price received by farmers. There's no effect on output, the timing of sales, or unit production costs. And it's consistent with the Rothenberg-Saloner hypothesis of collusion, because it appears, therefore, if we believe in, at least it's consistent with that theory. So presumably, this is the best explanation we have of why the information treatment effects are varying so much across years. Okay, so I am 1:15 exactly. I have 2 minutes. Will you give me 2 minutes? So, okay. You may ask, okay, I'm just going to give you the bottom line for each of the next couple of results. Well, this was the gap between the mandi price and the farm gate price. But what about the effect on the transactions between wholesale traders and the local traders? We didn't expect any effect because local traders they have access to good information in a way that farmers don't. So we don't expect that the information treatment effect would really affect relative access to information of local traders vis-a-vis the wholesale trader. And so that's exactly what we find, except that the precision of that estimate is low because we have fewer traders. We have 200 traders as against 1,500 farmers. The other question was, what happens if you offer credit to farmers, microcredit to farmers? So we carried out this microcredit intervention. And microcredit might help farmers with respect to their marketing for 3 possible reasons. One is that if their cost of credit is very high, farmers must sell most of their crop at the time of the harvest. They can't afford to delay the sales to later in the year when the price is going to be higher. So if you give them microcredit, it might allow them to store and sell later in the year and obtain a higher price. We already saw that there's no such effect there. So we'll find that this channel doesn't operate. Second is that the farmers may depend on traders for trade credit. So it increases lock-in to a specific trader. Sometimes the interlinkage, the bundling is that I'll give you credit, but you have to commit to sell to me rather than to any other trader. So that could be a second. It could be anti-competitive. And the third could be that the farm gate price includes an implicit charge for trade credit. So again, because I'm out of time, there were 3 different credit treatments. I don't have time to get into the details, but the bottom line is that all the credit treatments had 0 effect. Okay. So let me summarize. The credit treatment effects are negligible and insignificant. Now, let me just go to the last summary. So what are the main takeaways? So the supply chain is showing large gaps in prices received, in margins, and passed through across different vertical layers. And we are finding evidence which is consistent with frictions that result from a combination of trader collusion and asymmetric information. And the experiment showed that a policy of disclosing price information to farmers can significantly reduce this gap, these frictions. But this doesn't operate all the time. It operates only in high price years. Microcredit provision is not effective in increasing farm gate prices. So credit constraints don't seem to be important. And the last remaining puzzle is that the price gaps are really large between the wholesale and the local traders, which is probably due to some kind of collusion, but our capacity to study that is limited because of very limited data at the wholesale level. Because wholesale traders are, they're big business people, and they don't want to mess around with academics trying to collect data. Okay, so that's the challenge for all of you. Some of you can make progress with understanding wholesale traders. That would be terrific. Thank you. Could I request just 2 or 3 questions at a time, because otherwise I'll forget all the questions. Sure.
Yeah, thank you, Professor Mookherjee, for this very interesting research, well-grounded in economic theory. I'm still puzzled about this closed-door price policy. And my question is, what closed-door mandi price policy? What are the institutional mechanisms that allow these traders to not reveal price, and other than traders, other stakeholders have a strong incentive for these prices to be. Why does buyers as well as farmers, given that information has such a strong impact, what prevents from these prices to be?
I don't know. So it's the way I believe the mandi is operated. Instead of leading wholesale traders, they have made plans to sell to buyers. So buyers have arrived, they arrive usually in the morning, or their agents arrive in the morning, and they say, this is the amount that I want today. Then the wholesale sellers will line up their agents, their suppliers, and say, I want so many potatoes. They spend the whole day gathering those potatoes. The potatoes are inspected and so on, and then it's all ready so that the trucks are loaded. At 7 o'clock in the evening, a group of buyers and a group of sellers enter a particular room in the mandi. It's a closed door. They negotiate, and they negotiate a price. And that is the price at which the trade happens for different varieties. And that price is secret. And it's the people that we bribed were their assistants who are sitting in that room. Now, what sustains this mechanism, I don't know. And what are the motives, I don't know. You can speculate what the motives may be.
So my question is in the context of frictions in the first upstream flow in the supply chain, where there are a large number of farmers and local traders, and in the local markets it's procured. So could there be there could be a lack of cost transparency? Farmers, local traders could procure foods or products from the farmers at different costs, and it could then be sold in the wholesale market at a different cost. And there could be a friction because of this lack of cost transparency. So what could be potential channels to alleviate this so that the transaction costs are reduced? This friction could be eliminated. Are there some channels that could be possible?
You mean the upper level trader, the wholesale trader doesn't know about what price the intermediate trader had procured from the farmer? Yeah, no, that's a good question. I haven't thought about that. But that they know that these local traders are buying from many different farmers. These guys are, they're doing big deals, and they know that they are aggregating across a very large number of farmer suppliers. So I think it'd be, even if they were to try to collect that information, it would be forbiddingly complex, difficult for them to do it. And then there would be problems about disclosure. So I think they just guess. They have a pretty good guess, perhaps, but I think so. That is another information gap. You're right. That's an important, conceivably important information gap. I don't know what the implication of that information gap is. Yeah, so that's a good question. I don't know the answer.
In the upstream flow or in the supply chain, this gap could create substantial frictions for.
I don't know. I mean, I'm sure, this is exactly why, Amazon likes to collect, your clicks information, because they may have aggregate statistical information, have a distribution of buyers, let's say, I'm just reversing things. So when a seller is trying to price discriminate, depends on what information the seller has about the buyer characteristics. Similarly here, buyers are trying to discriminate amongst different sellers based on their specific characteristics. And the more individual information you have, the more you can sort of increase your capacity to discriminate. So obviously there's a huge demand for that information. I don't see how they can actually conceivably collect that information in any realistic fashion. But maybe in an AI age, things are going to change. But so anyway, that's a good question, and maybe you want to work on it.
Yes. So another question is that if we assume that there is a collusion according to Rottenberg-Sellner model, that itself demand that the market needs to be oligopolistic so that there is some collusion, right? But here we said that the concentration is not an issue. There are, or even if it is there could be many more entry in the, the wholesaler trader level that it can sustain over a long period. So
when I said, I mean, the thing is with Bertrand competition, if you think of a perfectly homogeneous product with Bertrand competition, the product here is pretty homogeneous. Most of what I showed you is just Jyoti, right? So Jyoti, ready, Jyoti, variety, it's pretty homogeneous. So if it was static Bertrand competition, okay, then the price should be bid down to cost, right? So when I say there are enough buyers, I mean, the median I told you is about 9 village traders per farmer and about 5 wholesale traders per local trader. So that's enough, I think, if it were just textbook Bertrand competition. But it's still 5 or 9. But when it comes to this kind of dynamic self-enforcing collusion, if you had literally thousands of sellers, it would be very hard for them to coordinate and discuss and coordinate those strategies. So if you have something like 5, 9, 10 people, that's quite plausible. I mean, there are theories of how. I mean, I remember there was a paper by, I think, Green and Shankman in the Review of Economic Studies in the 1980s, arguing that doctors in California collude through, you can imagine how many doctors there are in California. So there are theories of how even very large groups can collude through this implicit dynamic self-enforcing collusion. So anyway, you can read, I always I couldn't believe the Green Shankman story, but with 5 to 9 traders, I think it's fairly plausible. No, that I told you, there is hit and run entry is not possible because you need substantial capital and reputation. So yeah, so that precondition is met here. Sure. Yeah.
So I think we are out of time, getting late for lunch. So once again, thank you very much, Professor Mookherjee. I will request our colleague, Professor Shobhit Dash, to hand over a very small gift as our token of appreciation. So those of us who have known Professor Mookherjee for years, I really wanted to say this. We know that how much he, to us, he has been like a teacher and a mentor, how much extra effort he takes in mentoring students and junior colleagues, especially in India, in cultivating research in India, and many of his initiatives, including the Society for Economic Research in India and many others. So on that note, a final thanks to him and to all of you for attending with so much enthusiasm. Now we are breaking for lunch. We have the lunch at the center building straight across this building. So the volunteers are there to help you to show the lunch venue. It's on the first floor of that building. And we will be back here to start our next session. To start back at the different rooms parallel for the parallel sessions to start by 2:30. Just a small request.